When you start investing, you learn a few commonly accepted investing wisdom and steps you take as facts and follow. As you gain more experience, you start questioning those facts. What seem to be absolute wisdom reminds you of the sweet little lies parents tell their kids about Santa Claus and tooth fairies. Today, I'll introduce and debunk 5 investing fairy tales and myths that beginner investors should know before starting. I'll also give you a 5-step ultimate guide to replace those myths. If you are a new stock market investor, this episode is the one you don't want to miss. Hello, my name is Mer. I'm the founder and CEO of Stockcard. Once upon a time, like many new investors, I believed I needed to follow 5 steps to become a great investor. Those were 1. Set financial goals by understanding my risk tolerance, time horizon, and investment objectives. 2. Start with paper trading to learn how to invest because you learn by practicing. 3. I invest in things I know and avoid those things I don't know or understand. 4. Research and gather information about reasons to invest in a company. And 5. Keep myself constantly informed about the economy and the stocks I own to make informed buy or sell decisions. Those all seem quite logical. And if I Google the most important things the new investor needs to know to start investing in the stock market, the research result would include all or some of those steps. Now, which one of those 5 steps do you think are fairy tales and not true? Any guesses? Today, I will walk you through all 5 steps and prove they are all fairy tales and investing myth you should avoid if you want to become a better investor and make money in the stock market. I very well expect some of you to start yelling at me in the comments at some point or close your browser because what I'm going to say is against everything you've been told so far as the steps to follow to become a better investor. But before leaving, I want you to stay around, hear me out, and reflect on my myth-busting logic. You may change your mind about a few and become a better investor for it. Before we start, as a reminder, I'm not a financial advisor. This episode is based on my personal experience and is for education and entertainment only. Talk to a financial advisor, or better yet, educate yourself. Let's debunk the first investing myth: setting financial goals by understanding your risk tolerance, time horizon, and investment objectives. Literally every investing or personal finance application you open up asks you about your risk tolerance, when you plan to retire, and how much you need to generate in returns. Those are very logical questions. But the problem is that no one knows the answers if you're honest with yourselves. Let's say you're in your 20s. You don't know where you live the next year, yet alone when you plan to retire. Yes, back in good old days, everyone started working in their 20s, worked for 30 years, and then retired in their 60s. People's lives used to go on a smooth line of school, work, family, more work, retirement, playing golf, and dying. But that's not true anymore. Your life can be school, early mini retirement to travel, family, work, start your business, take some time off to raise your children, move to another country, never retire because you like the work you do, and then die. Setting rigid financial goals makes you inflexible in your life. Before you close the browser or start yelling at me in the comments, let me explain. If your goal is to retire by 60 and you set it up at 30, you need to contribute a specific amount to your retirement account every month, which you must keep up for 30 years. the chances are you say no to several life-altering opportunities such as starting a business or taking a sabbatical year to enjoy life just to stay on track to retire at 60. It's also possible that in your 30s, you underestimate how much you need when you retire, and you may start your path to retirement by under-contributing. The difference between contributing 5% or 10% of your income to your retirement plan is in thousands of dollars. Your risk tolerance is also changing. You may have seen your parents lose money in the stock market and decide not to invest and keep money in cash in your 20s. And as you gain more experience, you realize you were wrong. How do you compensate for years of no investment in your early 20s and 30s? So what to do instead? Set a financial system or a path to financial success. Listen, the formula of wealth is very simple. It is your income minus expenses to the power of investment return. Or in simple words, grow your income, reduce your expenses, and invest the difference. As an early investor, ask yourself how to grow your income and reduce expenses consistently. That means as soon as you get a job, ask yourself, how can you double your income in this job? Or what's the next job to double your income? Look at your credit card and ask yourself, how can I cut these expenses by 10% every month, and so on. Instead of letting your young 20 or 30-year-old dictate the life of your 60 and 70-year-old future, understand the simple formula of wealth and develop a system that sets you on the path to wealth. Investing fairy tale number 2. Start with paper trading to learn how to invest because you learn by practicing. Paper trading refers to a fictional trading account many brokerages offer, so you can start investing with a fictional $1 million to learn how to invest. Many apps are out there and millions of new investors start their journey there. It is one of the investing myths I hate the most. It is based on the logic that practice makes perfect. If you want to become the most valued basketball player, you play a lot of basketball. It's true in basketball, but not in investing. Do you know why? Success in investing isn't just the hard skill you acquire by practicing to trade. There is one very important skill that differentiates good investors from losers, and that's your emotional control. No one put it better than Peter Lynch when he said,
and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is, and I'm ready for questions.
Having a stomach in investing means you can tolerate the market's ups and downs, not selling something too soon because it just went up 50%, or not selling another investment just because it's down 50%. The stomach differentiates the ultimate winners and losers in the stock market, not the brain. When you paper trade, losing money doesn't hurt as much as trading real money. You can never develop your investing stomach by losing fake money. Experiencing the pain of losing money and learning how to control that nagging inner voice that wants to sell everything at a loss to sleep well at night is the real investing skill you need to develop. I even go to the lengths of saying you can't develop your investing brain with paper trading either. You learn when the result matters and you have a stake in the game. Paper trade with fictional money has no consequence in your life, and most people do not learn the hard skill they need to analyze a stock or a fund by casually making buy or sell decisions. Learn to invest by jumping in and investing real money, however small, and do not paper trade. Investing fairy tale number 3. Invest in things you know and avoid those you don't know or understand. This is the one myth that may finally get you to yell at me in the comments. After all, investing in what you know is the advice of the investing sage, everyone's favorite investing uncle, and the one of the richest men on earth, the one and only Warren Buffett. How could something Warren Buffett says be a myth and wrong for new investors? Well, when Buffett says to invest in what you know, don't take it at its face value. Consider the context behind it. When you start investing, chances are you don't know anything about investing. Even if you are an engineer who knows how computer chips work, the chances are your knowledge about cash flow and margins is quite limited. Unless you majored in finance or accounting, no one knows anything about what's a good investment when they start investing. Secondly, if you only focus on what you know, you deprive your portfolio of some of the best investment opportunities out there. We all know how grocery stores make money and what it takes to run a retail store. You buy things, get a store, put them on the shelves, sell them, and make money. Easy. But if you only limit your investments to things you understand, you end up with only Sears and Target and Walmart in your portfolio. And that's it, depriving yourself of mind-boggling investment return in areas such as innovation in technology and healthcare. Thirdly, research Buffett's life. He says to stay away from things you don't understand, but the man has spent all his life reading and understanding what he invests in. He has developed what's known as his circle of competency in the airline, banking, insurance, and physical infrastructure industries. He understands many things because he consistently learns and expands what he knows and understands.
The other great secret is that we're good at lifelong learning. Warren is so much better in some ways in his 70s and 80s than he was younger that it's almost awesome. If you keep learning all the time, you have a huge advantage.
Invest in what you know is a myth. Never say no to new investment ideas under the assumption that Buffett only invests in what he knows. Learn about new business models and companies, expand your circle of competency, and only then decide. Investing fairy tale number 4, research and gather information about reasons to invest in a company. Well, let me be straight with you. Researching and gathering information about the reasons to invest in something isn't a myth. It is required. And I'm not against it. I actually founded our company, StockCard, to make investment research digestible for investors like you and me. But researching is not enough. You see, most people first decide to invest in something and then gather information to prove that they're right about it. Especially new investors tend to fall for a mistake known as confirmation bias. Your investment decision is biased towards the facts confirming your buying decision. The reverse of it is possible too. The investor starts with a negative perception of a company or a stock because she read or watched her favorite YouTuber talking against it. Then she focuses on collecting information and facts to confirm that investing in it is a bad idea, just like what she knew from the beginning. I do not know any new investor who asks herself, what if I'm wrong? What evidence is there to disprove my opinion and the facts I gathered about this stock? It is said that Darwin had the habit of carefully writing down anytime he heard of an idea that disproved his own beliefs. He knew his mind would push back the idea to avoid doing extra work. You and I have the same brain as Darwin did. If we like to invest in Tesla, anyone who says anything against Tesla, we get angry and bash the idea or the person who shared it. As they say, the sign of intelligence is to have two opposing ideas in your head and not to go insane. In practice, every time you research a stock, commit to collecting 3 facts that counter your argument and then decide to invest if you still believe you are right. As a side note, a stock card can help you with that. On a stock card, we collect more than 300 pieces of information about every publicly traded company. So all you need to do to find counter arguments to your research is to look up that company's stock card. If you are for investing in that stock, look for red sections of its stock card. Those are your risks. If you are against investing in a stock, look for the green sections of its stock card. They highlight what's going well for the company. Then sit back and balance your point of view with the counter arguments you've gathered and only decide then. If you're not a stock card user, try it by looking up your favorite stock on a stock card today. So don't just research a stock, do a counter research too and find your blind spots. That brings us to the last investing fairy tale. Keep yourself constantly informed about the economy and the stocks you own to make informed buy or sell decisions. This is the easiest one to disprove, and there are many ways to go about it. I chose an interesting approach to it. Think about the business model of news websites. They make money through advertising mostly. They need you or I to spend more time on their websites or application to make more advertising dollars. They have to trigger you emotionally or intellectually to attract you to stay there or come back. If after a company's quarterly earnings, they post an article that says, Apple's quarterly earnings were nothing to worry about. In the long run, these short-term fluctuations do not matter. Do you have any incentives to click and read? No, you won't. And the media website makes no money. Instead, they find the slightest changes in financial information and put it in a sensational title, making sure you get scared or excited to click and read. For that reason alone, paying attention to the news is more like a way to make the media companies money and not to manage your own portfolio. Companies take years to build and become successful. 1 quarter or even a year makes no difference. The global economy is changing, politicians are coming and going, and technology is evolving. Those impact the profitability and revenue growth of the companies you invest in at each moment. If you invest in a company that has found a way to make money, it is almost impossible to lose its ability to make money in 1 quarter, unless there's fraud or natural disaster. Even if there is a natural disaster, if you've done your research and have found your blind spots, as we discussed in the previous section, you already have thought about it and invested in a company with a lot of cash or access to capital that can weather such disasters. If you do your research and be aware of your blind spots, there is no reason to chase the news. Your time is better spent learning and expanding your circle of competency we discussed earlier and opening your mind to new investment opportunities. Let's wrap up. Today we discussed and debunked 5 investing myths and fairy tales for beginner investors. Therefore, my ultimate 5-step guide for beginner investors is the opposite of the fairy tales discussed today. Don't set financial goals, develop a wealth creation system. Learn to invest by investing real money. Constantly expand your circle of competency by learning. Researching reasons to buy a stock is not enough. You need to find your blind spots. Don't waste time chasing the news in the name of staying informed. We've also discussed how a stock card can help you. Give a stock card a try to research a stock or an ETF, and more importantly, find and monitor your blind spots. If you need tips on using a stock card to find the best ETFs as an example, I recently published a video and the link is in the show notes. I highly recommend you watch it. See you next time.